let's break down the Black-Scholes Option Pricing Model in a simple way that's easy to understand. What is the Black-Scholes Option Pricing Model? The Black-Scholes Option Pricing Model is a mathematical formula used to determine the price of options. An option is a financial contract that gives you the right, but not the obligation, to buy or sell an asset like a stock at a specific price before a certain date. How does it work? The model takes into account several factors to calculate the price of an option. 1. Current price of the stock, how much the stock is worth right now. 2. Strike price, the price at which you can buy or sell the stock is specified in the option contract. 3. Time until expiration, how much time is left until the option expires. 4. Volatility, how much the stock price is expected to fluctuate. 5. Risk-free interest rate, the return you would expect from a risk-free investment, like government bonds. Practical example. Imagine you have an option to buy shares of a company. Let's call it TechCo. At $100 per share, this is the strike price and the option expires in 1 month. Factors: current stock price, $105. Strike price, $100. Time until expiration, 1 month. Volatility, how much the stock price is jumping up and down. Risk-free interest rate, let's say it's very low, like 1% per year. Using the Black-Scholes formula, which is a bit complex, you can calculate how much this option is worth right now. Simple example. Let's say you want to buy a concert ticket, but you're not sure if you'll be able to go. You have an option to buy the ticket for $50 anytime in the next month. Current ticket price, $35. People are buying and selling tickets for this price right now. Strike price, $50, the price you can buy the ticket for. Time until expiration, 1 month. The concert is in a month. Volatility, high, because ticket prices can change a lot as the concert date approaches. Risk-free interest rate, low, because you're not making an investment here. Using a similar idea as the Black-Scholes model, you can figure out if this option to buy the ticket is worth something. If the ticket prices are very likely to go above $50 before the concert, the option becomes valuable. Why is it useful? The Black-Scholes model helps investors understand the value of options, which can be very complex. By using this model, they can make more informed decisions about whether to buy or sell options, and how to price them correctly. Real-world application. 1. Investors use the model to price options and manage their investment portfolios. 2. Companies use it to determine the cost of employee stock options. 3. Traders use it to identify profitable trading opportunities in the options market. Simple explanation. Think of the Black-Scholes model like a special calculator that helps you figure out the price of a complicated deal. Just like you might use a calculator to add up your allowance savings, investors use this model to add up all the important factors that affect the price of an option. This helps them know if they're getting a good deal or not.